Welcome. Today we're diving into IAS 8, a crucial accounting standard that guides how companies handle changes in accounting policies, estimates, and errors. Understanding IAS 8 is essential for anyone involved in preparing or analyzing financial statements, as it ensures consistency, transparency, and comparability across reporting periods. In this video, we'll break down the main areas covered by IAS 8, explain the different treatments for each, and provide practical examples to make these concepts clear. Let's get started by exploring what IAS 8 covers and why it matters for financial reporting. IAS 8 addresses three main areas: accounting policies, changes in accounting estimates, and errors. Each of these areas has specific rules for how changes or corrections should be handled in financial statements. The goal is to ensure that financial information remains reliable and relevant, even when adjustments are necessary. By following IAS 8, companies can provide stakeholders with a clear and accurate picture of their financial performance and position. Now let's take a closer look at each of these areas, starting with accounting policies. Accounting policies are the specific principles, bases, conventions, rules, and practices applied by an entity in preparing and presenting financial statements. These policies must be applied consistently from one period to the next, unless a change is required by an IFRS standard or will result in more reliable and relevant information. Consistency helps users of financial statements compare results over time, making it easier to spot trends and make informed decisions. But what happens when a change in policy is necessary? Let's find out. Company may need to change its accounting policy if a new IFRS standard requires it, or if the change will provide more reliable and relevant information. For example, switching from a cost model to a revaluation model for property, plant, and equipment is a policy change. When this happens, IAS 8 requires the change to be applied retrospectively. This means the company must adjust prior period financial statements as if the new policy had always been in place. This approach ensures comparability across periods and maintains the integrity of financial reporting. Let's look at a practical example. Suppose a company previously measured its buildings using the cost model, but decides to switch to the revaluation model. According to IAS 8, the company must restate its prior financial statements as if the revaluation model had always been used. This retrospective application helps users see what the financial results would have looked like under the new policy, making it easier to compare past and present performance. Now let's move on to changes in accounting estimates. Accounting estimates are adjustments made to amounts in the financial statements based on the latest available information. Examples include estimating bad debts, the useful life of assets, or fair values. These estimates are necessary because some financial statement items cannot be measured with absolute precision. When new information becomes available or circumstances change, companies may need to revise their estimates. But how should these changes be treated? Let's find out. When an accounting estimate changes, IAS 8 requires the new estimate to be applied prospectively. This means the change only affects the current and future periods, not the past. For example, if a company revises the useful life of a machine, the new depreciation expense is calculated from the current period onward. There's no need to adjust prior period financial statements. This approach reflects the reality that estimates are based on the best information available at the time and may change as new facts emerge. Imagine a company estimates that a piece of equipment will last 10 years, but after 5 years, new information suggests it will only last 2 more years. The company updates its depreciation calculation for the remaining useful life, starting from the current year. Past financial statements remain unchanged. This prospective approach ensures that financial statements reflect the most up-to-date information without rewriting history. Next, let's discuss how IAS 8 deals with error. Errors are material mistakes in prior period financial statements, such as omissions, misapplications of accounting principles, or even fraud. These errors can significantly affect the reliability of financial information. IAS 8 requires companies to correct material errors by restating prior period financial statements. This retrospective correction ensures that users have accurate and trustworthy information, even if mistakes were made in the past. If a material error is discovered, IAS 8 requires companies to correct it retrospectively. This means restating the affected prior period financial statements as if the error had never occurred. By doing so, companies maintain the integrity of their financial reporting and provide users with the most accurate information possible. This approach applies whether the error was due to oversight, misinterpretation, or intentional misstatement. Suppose a company discovers it omitted a significant expense from last year's financial statements. Under IAS 8, the company must restate last year's figures to include the missing expense. This correction is applied retrospectively, ensuring that the financial statements accurately reflect the company's true financial position and performance. By correcting errors in this way, companies uphold the trust of their stakeholders. Summarize the treatments for each area covered by IAS 8. Changes in accounting policies are applied retrospectively, meaning past periods are adjusted. Changes in estimates are applied prospectively, affecting only current and future periods. Errors are corrected retrospectively with prior periods restated. This table helps clarify the different approaches and ensures you know how to handle each situation correctly. Make things even simpler, remember these rules. If it's a policy change, look back and restate past periods. If it's an estimate change, look forward and only affect current and future periods. If it's an error, correct the past by restating prior financial statements. Keeping these basic principles in mind will help you apply IAS 8 correctly in any situation. IAS 8 is vital for maintaining the credibility of financial reporting. By ensuring that changes and corrections are handled consistently and transparently, It helps companies provide reliable information to investors, regulators, and other stakeholders. This builds trust and supports better decision-making. Whether you're an accountant, auditor, or financial analyst, understanding IAS 8 is key to upholding high standards in financial reporting. Summary: IAS 8 provides clear guidance on how to handle changes in accounting policies, estimates, and errors. Remember, apply policy changes and error corrections retrospectively and estimate changes prospectively. By following these rules, you'll ensure that financial statements remain accurate, comparable, and trustworthy. Thanks for watching. If you found this video helpful, don't forget to like and subscribe for more accounting insights.
Kindly like, subscribe, and press the bell icon so you never miss any video.